Welcome back, everybody, to Founders Corner. In today's episode, I have Marco, who's from McCarthy Tetrault, and he is actually a startup expert lawyer who we actually were able to communicate with and really have an awesome conversation about what it is that most startups have for pitfalls and what they can do to avoid those pitfalls. So, Marco, welcome to the channel. How you doing?
I'm so excited. Thank you for having me.
Excellent. So, Marco, look, I've been in the startup world for a while now. I've done a bunch of ventures. Look, no one likes to deal with lawyers, right? Especially at the startup phase. You know, you're in that like really awesome environment where you're like, everyone's jazzed. It's a new idea. Let's go get it. First of all, tell me how you got into the world of startup law, because for startup world, like that's a niche market and I love it.
Yeah, for sure. Yeah, I think the role of a lawyer, really, we tried to, keep the enthusiasm of the founders, but we take all the difficult stuff and deal with it in the background. But how I got into this, I went to Wilfrid Laurier for my undergrad. I did business. Always had an interest in startups, and Kitchener-Waterloo being what many call the Silicon Valley North. I've had lots of exposure to startups and emerging company work, even as an undergrad student. So I did a lot of pitch competitions and just basically really getting to know and operating in that entrepreneurial space. So after completing law school, I really wanted to come back into this environment and using my newfound legal knowledge now to carve a career for myself where I can use both business and legal to help startups and emerging companies.
So what would you say is the number one pitfall that you see consistently? And I'm going to gather a guess. Okay, so hold on. First, before I guess, I'm assuming you work with the founders, right? It's usually there's usually two founders, right? So let me guess. They do not have an agreement between each other. That's usually what I see all the time. So what would you say is the number one pitfall?
Yeah, I mean, not having a shareholders agreement early enough, or just operating the company without an agreement. That's really common to see.
Yeah.
That's one of the pitfalls I definitely have on my list. But the most major pitfall, and it's more a general point, is just not keeping your company's minute book and corporate records up to date.
Yeah.
And that's totally understandable, right? Yeah.
Yeah. And you know what's funny is that anytime I talk to startups, and first of all, I always do talk about agreements, and those things are huge, especially once you've been burnt once or twice. Like you take those things quite seriously. But one of the biggest things for me is when I talk to them, I always tell them, look, don't, because a lot of times they stress out about it. And I say, look, and tell me if I'm wrong. Well, I don't think I'm wrong, but you can comment about this. But with law, you can always update the minute book. You can always bring it up to date. It's just more expensive because there's a lot of things that the lawyers have to go and backdate and do a lot of basically cleanup, especially when you don't do it right the first time, where it's going to cost you a lot more to do the cleanup than it is if you just did it right the first time. Would you agree with that?
Definitely. And the trend is that a lot of companies, especially founders who are just so busy, hiring the right candidates in product development, trying to get their products and services to market, corporate records and minute book updating, this is often put to the back burner, right? And for good reason, because like you said, a lot of the time, these records can be rectified at a later time. Usually that happens at the stage of the company's first major financing.
Yes.
Whether it's Series Seed or a Series A.
Yeah.
But what that means is that if you haven't had good corporate records up until that point, the investor and their lawyers are going to find out, and they're going to look under the hood. They're going to mark all the deficiencies. And it's going to cost you a lot more in that diligence process.
Exactly what I say is if you keep your books up to date and clean, the the factor of getting a raise at like seed and series, like you said, it becomes so much faster because the due diligence happens faster. There's no there like
Yeah.
the books are up to date, everything is good to go. When the books aren't, you have to then panic fix everything, right? And you're not getting the money until that's
Yeah.
done. And then what happens is, of course, all the lawyers know when something has been done up to date or something that's been done just quickly just to fix things. And
Yeah.
it's not something wrong. Like you can still get through the process. It's just tough because what happens is it just delays that process of getting that funding. And you may be in a situation where you're like burning cash to the point where you're maybe a couple months out before your cash runs out, and you really need that
Yeah.
capital, right?
For
So
sure. Yeah.
what would you say is the
Yeah.
first thing that anyone that's about to start a venture, like a startup, what's your number one
Mhm.
advice for them in terms of whether it be minute book, whether it be agreements, like what steps should they take? What are the things they need to watch out for? That's a really good one.
Yeah, that's a really good one. So I wouldn't say corporate records and minute books need to be the first thing on their minds, because practically speaking, it's just not going to be the case.
Right.
And like we said, lawyers can rectify a lot of things. Usually, we try not to backstate documents as a general principle. But yeah, like oftentimes in deals and transactions, it's not really even the negotiation of the transaction documents that take the longest. Sometimes it's the due diligence process and
Right.
fixing those deficiencies. But as one of the first steps that founders should keep an eye on, at least legally speaking, they should figure out when is a good time for them to incorporate their business. And for a team with more than one founder, it's oftentimes beneficial, not just to the company, but to the founders themselves to enter into a shareholders agreement sooner rather than later.
So one of the things I always get asked is like, how much should I pay? How much shares should I give my co-founder? What do you see as a regular thing, or like I now that's a loaded question. I realize that because it depends on how much that co-founder is involved. But a lot of times, with especially with software startups, usually you have your founder, maybe an angel or a family round, and you got your co-founder, right? And your co-founder
Yeah.
is typically the technical side, the guy who's doing all the product and whatever it is. So what would you say is something like, how do you approach that conversation? Like, how do you go, you guys are I'm gonna give you guys 10% or 15% for being a co-founder. What's like, do you set up an agreement? Do you set up a partnership? Like, how do you handle something like that?
Yeah. Yeah, I think it really depends on the founding team. So sometimes we have a team of 2 to 3 persons, right? You have one person who is mostly the BD type of guy that's out there, soliciting business, or he or she would be the person with the idea, right? And then have another co-founder that handles everything happening in the back.
Yeah,
He or
and
she is kind of the secretary. Yeah,
I always tell people, just to your point, just because you have an idea doesn't mean it's worth anything. You have to have
definitely.
it. You
Yeah,
have to have an execution of that idea,
for
or at
sure.
least a plan of it.
Exactly.
And I think a lot of startups where they struggle, they go, but it's my idea, and it's like, okay, fair, it is your idea, but if you don't have a co-founder who can execute on this idea, it's just an idea. So is it worth that much, right? So that's what I always
Yeah,
tell
and
my
that's such an
founders.
important point. Yeah, such an important point. And that's why for teams of that nature, um, at least for incorporation purposes, there's usually a 50-50 split,
Mhm.
right? Between those founders. If it's a team of 2 persons, then getting that shareholders agreement becomes increasingly important
Right.
because the last thing a startup will want to do is to have a disagreement and have bottlenecks and
That's right.
basically indecision at the company level because time is always of the essence, right, for
Correct.
startups.
Yeah.
Um, so with a team of 3 people, it's a little bit easier because assuming all of them are directors and all of them are going to be shareholders, let's say it's an even split, then at least you're not going to run into a situation where there's a disagreement and there's just no way to go about that disagreement. You have at least a third person who can help, push the decision one way or another,
Right.
to at least move the company forward in those situations.
Yeah, I always the way and tell me how you feel about this, but the way I approach it is what's the value being brought to the table by each side, right? And I
Mm-hmm.
always tell people, I mean, like non-technical founders are typically not idea people, they're typically executioners, right?
Yeah.
An idea cannot be executed without an executioner. That's two. And then thirdly, you may be an industry expert. You may have the idea, you may have the workflows, you may have all the conceptuals of the product, which is totally fair. But are you bringing in clients? Are you bringing in what like and I always tell like anyone we work with, we say your number one job as a founder is not to focus on product. It's not to focus on anything other than selling, because that's the only person there that can sell. Because your technical founder isn't going to sell. Those guys are
Right.
introverts. They don't even like talking to people. That's why they deal with computers, right? They definitely don't like talking customers, right? Like for
Yeah.
us, like at Corridor, good luck getting a developer to talk to a client. Like there's no way. Like they would hate their lives. They just don't like that stuff, which is totally fair. Everybody has their advantages and disadvantages. And
Yeah.
as a CEO or the founder, especially the non-technical, you're going based on your charisma. You're going based on your passion for the project. You're onboarding employees, customers, angels, and VCs based on your passion,
Yeah.
showing them the story. Why are you here? And I feel like what ends up happening is a lot of founders sit there and they're kind of like, well, I'm just waiting for my non-technical founder to figure it out. And I think that's where the percentage is really important. Like you said, if both are bringing very, very similar, like balanced, it should be a 50-50, if not 60-40. But if you're a founder who's going to bring clients and bring in a lot of that stuff, and the non-technical founder is really just executing your idea, then like a 70-30, maybe 80-20 is reasonable. But
Yeah.
going back to being a founder at the beginning, we kind of said this at the beginning of the podcast. At the beginning of the project, everyone's happy, right? Everyone's so
Yeah.
excited, happy. And the term I use is when there's no money, everyone's working collaboratively and helping each other, and it's all team, rah, rah. As soon as there's money involved, then it gets greedy, right? And I'm sure you see this a lot in law, because that's really where the lawsuits start kicking in. And so how do you avoid, how would I say, how do you avoid that problem rising with the greed and the money? Is it through clear understanding of who's what and who's bringing what to the table? Because when you give away shares, it's really challenging to take that away.
Yeah, for sure. It's definitely a discussion amongst the founders. First and foremost, they have to understand their roles and responsibilities, what they're bringing to the table.
Mm-hmm.
There needs to be clear communication in terms of what their strengths and weaknesses are.
Right.
Especially for the founder with the idea, right? Your
Mm-hmm.
job is to sell your vision to everyone buy into that,
Right.
right? So that, very frank discussion is so pivotal
Yeah.
for startups. But that's where the legal also comes in to help the founders, right? You
Right.
have documentation that you can paper between you and your co-founders to basically provide you with a roadmap
Mm-hmm.
or some processes and procedures that you follow in the event of future unforeseen events
Right.
or disputes and disagreements. And shareholders agreement I talked about at the beginning of this podcast, that's what it does for the co-founders. It
Right.
lays out the lay of the land for different situations. and what processes will happen in the event of those scenarios, whether it's a founder exiting on good terms, bad
Mm-hmm.
terms. God forbid a co-founder gets sick and becomes disabled
Yep.
or even passes away. And what you said about the importance of issuing shares, that is so true, right? Because
Mm-hmm.
issuing shares, it's always easier to issue shares than to claw them back. But there are definitely ways that we can use in the shareholders agreement or in separate documentation to give the company a buyback or
Right.
a purchase
Option.
right.
Yeah.
Yeah, exactly. An option that they can exercise, or another co-founder can exercise, or other ways we
Right.
can put restrictions on how that departing founder can or cannot transfer their shares.
Yeah, and I mean, of course, there's a law aspect to it, right? So, like, for
Hmm.
if you get fired, I mean, in Canada, it's really hard to prove firing. Like, the government really doesn't allow companies to fire people in Canada. Like, it's very challenging. But in the States, it's way too easy to fire people, right? Um,
Yeah,
like you can have like a single cause of like, oh, you were asleep at your desk, you're fired, get out, right? I mean, it has a
yeah.
balancing act where you can kind of say, well, if you're fired, you forfeit your shares, right? Is there something like that? Yeah.
100%. And these can be terms that are papered in the shareholders agreement itself,
Right.
or each founder can enter into a separate agreement. It's kind of that reverse vesting concept, right?
Right.
So, founders, let's say there are three of them, it's an even split at incorporation.
Yeah.
But there can be an agreement that says, if you leave the company in a year, then only X percentage of shares actually vest within that year,
Right.
and those will be the shares that you can take away. The rest, the company has that purchase option, so that the founder isn't taking away 1/3 of the company's shares
With them.
with him or her when they leave.
Yeah.
Exactly.
Yeah. One of the biggest pitfalls I also see is when you're bringing on new employees and bringing them on with stock options. What are your thoughts around
Yeah.
stock options, or how do you entice, especially early stage employees, to want to
Mhm.
work their butts off without necessarily paying, full price? Because you can't, as a startup, you just simply cannot. It's a different breed, right? Like, startup world is like
Yeah,
very bootstrap, very like, how do we get this
for
going
sure.
as fast as possible? Like, that we got to hit market, we got to start making money, and then we got to raise money to sustain ourselves to keep that. So
Yeah.
what have you seen, if you've seen anything different than stock options? What is a good way to attract early stage employees?
Yeah, stock options is definitely really
And
good mechanism that companies can use,
Marco,
but
can we
it's got to be
explain?
used with caution. Yeah.
Yeah, can we explain stock options? Maybe some people don't know what stock options are. So can you explain stock
Oh,
options
sure.
in a legal way?
Yeah, for sure. So stock options are a little bit different than shares, right?
Yeah.
Once you issue a share, the owner of those shares have all entitled to those shares unless they
Correct.
enter into separate vesting agreements regarding those shares. But options, the the thinking here is that it's an incentive for future performance, right?
Right.
Because the way options work is that you get an exercise price, right? And that exercise price is usually the fair market value of shares right now.
Right.
So if you have an early stage employee that you retained, that exercise price is going to be low because right
Right.
off the bat, the company is probably not going to be profitable, and the fair market value of those shares would reflect the stage of that company.
Right.
But the idea is that those options are going to increase in value over time because of the employee's commitment to the company, because
Right.
of the company's growth and development. It's that vision at the end of the day, right? This is
Yeah,
what we can be in 5 years' time or 10
exactly.
years' time.
Exactly. Yeah.
Exactly. And, in 5 to 10 years' time, the hope is that the company would have gone through many stages of financing. There would be successful products and services, and the share price would be reflected as those successes happen, right? So at that stage, you still get to exercise those options at that very low initial exercise price, and that delta between the fair market values is what you're earning as an option holder.
Yeah, and what we find is like WeWork is a really good example of this. WeWork, I don't know if you know much about WeWork, but what happened with the whole Adam and the collapse of it all. So what happened was a lot of employees at WeWork, because they thought they were going IPO. There's also an event, right, in the contract of stock options
Mm-hmm.
where if we're going for Series D, E, F, G, you have to
Yeah.
either convert or you get left in the like your stock option expires. So what ended up
Mm-hmm.
happening is a lot of people took on extra loans to pay for those stock price or for the stock option. And what ended up happening, of course, we all saw with the collapse of the price of the stock. So a lot of people actually lost money on those
Mm.
stock options, right? Because they thought they were going for a 40
Yeah.
billion, 60 billion evaluation, and it ended up being 9 billion, right? And a lot
Yeah.
of employees actually got screwed over that way. And they took on debt
Yeah.
for that. They took on very, very extensive debt, especially for guys, especially for employees who are only getting paid, they're getting minimal. Like the whole concept is we're changing the world. Like that was their biggest thing, right? Is, what was
Right.
it? Something about consciousness. And so a bunch of
Yeah.
people joined in with the fact like, no, this thing is gonna go to the sky, right? And to be honest with you, the way I see um, Adam Newman is like, to me, he's such a showmanship kind of guy. He's very charismatic. He's all about
Very charismatic. Yeah.
very charismatic, but he's just like, I don't even know if he's charismatic or you people just don't understand really how, like, when he speaks, like he does have a heavy accent, right? And but he's just so confident in what he believes he can achieve. And so it's really hard as employees, because that is what it takes to be a really good founder. You have to be very confident. Charismatic is a big one.
Mm-hmm.
And a lot of the bigger successful companies, you'll see Tesla being one of them, Apple being one of them, Microsoft being one of them. The founders were, confident. They were all charismatic. But like, how can you differentiate, or how can you protect yourself as an employee, I guess, is a really good question.
Yeah. So option plans, right? So going back to the WeWork example, when we look at a company's ESOP, so we call it, or their stock option plan,
Yeah.
usually there's a provision in there that says upon a significant transaction, like an IPO or a change of control
Or
transaction,
VC. Yeah.
um, yeah, all unvested shares at the time of that transaction will automatically vest.
Right.
So this is very employee friendly because it means if you were hired, 2 weeks ago and none of your options have vested yet, but it just so happens it's your lucky day that the company is going through this significant transaction, then all of your options can still vest.
Right.
The idea of vesting is that it means you can now exercise them. And
Right.
that goes back to your point about taking out loans, right? Because for employees that join the company late, that exercise price is probably not going to be very small because it's going to be reflective of the value of the company's shares at the time the employee joined that company.
Right.
And they're thinking, well, if we work IPOs, we're going to be, basically in the riches, right? So
Yep.
let's take this loan, pay off that exercise price, and then we can partake in that IPO price
Correct.
when the transaction closes. So companies, it's actually also in the company's best interest to draft robust stock option plans with good language,
Hmm.
because it not only protects the company, but also protects their employees.
Right.
Um, Oftentimes in stock option plans, you have a provision that says, once an employee terminates their employment with the company, they have X number of days to exercise those
Correct.
options,
Yeah,
right? And
exactly.
because of how protective employment laws, at least in Canada, are, there are lots of requirements on how those provisions will need to be made aware to the optionee. So having good documentation up front that is compliant with employment laws, because options, they're not just securities. It kind of it overlaps with employment laws a lot, right?
Right.
So having good documentation there, um, it just helps resolve uncertainties or disagreements, um, in events where an employee leaves the company and they still wish to exercise options, but the company is telling them, "Oh no, you can't anymore because they expired."
Right.
It just
Yeah. Yeah.
Yeah, it just clarifies those situations and makes it easier for parties to deal with it when the time comes.
Right. Another one that I would say most startups struggle with is raising debt. I wouldn't say debt, but like raising at a seed level capital is it gets complicated because first of all, VCs don't just come in and say, okay, I'll give you $1 million at a $5 million valuation, right? You're
Right.
usually dealing with either small VCs or you're dealing with angels who are a little bit more risk averse and are more looking
Mhm.
at it like a convertible debt, or one of those. What are the benefits of raising a convertible debt for the startup versus just straight equity?
Right. So, convert note, it's really good for the investor. I'm going to say that
Of course,
because
it's there
it
to
has
protect them.
elements of both.
Yeah.
Right, exactly. So it's debt until that significant transaction happens,
Right.
right? So investors can still benefit under the debt qualities under that note. So there will still be interest accrued. There's still an obligation for the company to repay, but they can also participate on the upside, in case the company is able to land that Series A or that Series C round, in
Yeah.
which case that convertible note will automatically convert into shares,
Right.
right? So, from a company perspective, convertible notes are definitely easier to negotiate,
Right.
right? There will be way less closing documents you need. And it's just a matter of negotiating that form of that convertible note with the lead investor. And then you can basically duplicate that form with all of the follow on investors as part of the round.
Got it.
There are usually way less disclosure obligations on the part of the
Yes.
company
Yeah.
when you're completing a convertible note round versus a Series A, or a Series C, even. So, in terms of legal cost and time to close those rounds, it's much simpler. So, it's better for companies that needs to get money into their door quicker. And we
Yeah.
usually see convertible notes happen sooner than that first major priced round, and
Right.
um, that's why convertible notes contemplate future price round happening,
Yeah.
right? But yeah, as compared to shares, angel investors, maybe they want shares, common shares usually, not preferred shares.
Yeah. Preferred
And that's
shares, I
not
feel
difficult
like,
to paper as
yeah,
well.
preferred shares are like more Series B, C, D. It's hard to give preferred shares. And by the way, for the listeners, just so you know what's the difference between a preferred share and a common share. A preferred share is Marco. You could explain it better than I could probably, but I'll just generalize it. Essentially, it's basically when there is like a closing round or a payout round, preferred shares get paid before debt and common, correct?
Yeah, that's usually the case. Preferred shares have priority or
Yeah.
preferential treatment in the event of liquidation, like you said.
Yeah.
So when there's a change of control, transaction, a sale of the company, whether by shares or by assets, they usually have liquidation preferences, is what we
Right.
call it, to the common shares. And then we can get into the whole participation and non-participating aspect as well. But yeah, preferred shares, they usually also have preferential rights when it comes to dividends, for
Right.
example.
Yeah.
Sometimes they just share in equal dividends with common shares, but other times
They could just be
investors
pied
can insist
by
on a
themselves.
specific percentage.
Yeah.
Yeah, and sometimes it's even cumulative,
Yeah.
right? They also have preferential voting rights a lot of the times.
Yes.
Like, for example, they have rights to vote on specific matters that they can veto.
Yeah.
Usually, these are major events that the company is thinking about doing.
This includes
So
selling. This includes selling your
it
company.
definitely includes
Yeah.
selling. Yeah, even
And
increasing the
that's,
size of your board, for example.
yeah,
Yeah,
that's, those are huge, by the way. And I do tell people, avoid preferred shares as much as you can for as long as you can. There is going to be a point in time where you're just going to get so much cash. Like, hopefully you're growing, you're blowing up. You're going to hit a point where you're going to hit an area where maybe an investor comes in and says, I'll give you 100 million, but they're gonna, like, that's amazing evaluation for you. It could put you in the $1 billion category, but you're giving away preferred shares at that point.
yeah, for sure. So you definitely want to wait on those preferred shares when the right institutional investor comes along. You
Correct.
don't just want to be giving away preferred shares to angel investors, for example,
No, you lose
because
so much power that
negotiating the
way.
terms. Yeah, exactly. And to negotiate the terms of those preferred shares, that's a lot of time and legal cost in and of itself, right?
Right.
And when that future institutional investor comes along, you're going to have to go through that process all over.
Agree. Again, yeah,
Yeah,
that's true.
so it's just way more efficient to, like what you said, to really
Delay.
wait for the right moment.
Yeah.
Yeah, exactly, for
Yeah.
those issuances. Yeah.
It's a funny joke. I always say, founders in our mind, we're so lonely, right? We don't believe anyone is believing in us, and it's tough because whenever an investor does come to you and says, "Okay, I'll invest," like, we've gotten rejected so many times, to the point where, like, you, like, when that person says, "I'll invest in you," you're like, "Oh my God, what do you want me to do? Do you want me to cook you dinner? Like, what do you need me to do for you?" Right? So it almost becomes that
Yeah.
aspect of, like, I'm so grateful that you're doing this with me, but sometimes that leads to poor decision making, and, like, maybe taking money from
Yeah.
someone you shouldn't take money from, and that happens sometimes, right? Where you're like, I need the money, but it's like, but if you take this money, this person is really just walking into your boardroom. This person is now going to have a lot more power, that maybe if you're not aligned, that power
Yeah.
can become a power struggle, which then could lead to you
Yeah.
being ousted, right? So I think there's a lot of factors that need to be thought through, especially when it's about taking money and taking investment as a startup, whether it be early stage or later stage. It doesn't matter. You really do have to think it through. I mean, I think a lot of startups, they're so excited about I call it the startup gold rush, where everyone's just jazzed about, like, being able to raise millions of dollars on a software concept, and it's like,
Yeah.
yes, but what cost? At what cost do those things come at, right? How many startups, how many software startups have we seen, right? In the millions, I would
Mhm.
say. Um, and you're only hearing about 5, 10, 20, 30 of them, right? So just
Yeah.
visualize that for a second. It's not that much of a gold rush. I mean, there's a lot of money out there, there's a lot of deal flows happening, but those deal flows are not necessarily for everybody.
Yeah, exactly. And that's why it's so important at the time when you're speaking to investors to really figure out whether there's a good fit,
Yeah.
right? They shouldn't be just coming in with the money, but they should also have strategic
Yes,
connections and
that's
knowledge
right.
in the industry that you operate in so that they can be a good business partner going forward.
And
Because the last thing you want to do is close the deal, and then a year or two later, you ran up disagreements with the investor and they want
bang
out.
on.
Right?
One of the
Right?
things I do,
Yeah.
if the advisor or if they have a great strategic partnership capability, is an advisory board. Because you would give
Mm-hmm.
away shares, I guess. It would be more like stock options or however you want to structure the whole thing. But essentially, an advisory board helps because you don't want to just give away board seats. Board seats are way too powerful. An advisory board, though, allows them to benefit if they're strategically helping you.
Yeah. Right. Exactly. The point of Series A or later, it's common for the lead investor to ask for a board seat. Um,
Yeah, of course.
Usually, companies really push back too hard on this point. But that said, the negotiation on the restrictions put on that board seat, that is all for grabs, right? And
Yeah,
that is why it's so important to have these discussions at the term sheet negotiation stage.
yeah,
So you can put some of these terms on paper so that you don't run into these issues at the time when your lawyers are drafting,
yeah.
because those back and forths can be the areas that really run up the legal costs.
Yeah, agreed. Well, listen,
Yeah.
Marco, thank you so much. I mean, I hope all of our startups kind of listen in on this because this is a very important episode, in my opinion. It's such a big problem within law and startup where the due diligence doesn't happen or the documents don't happen or they don't really think it through, and there's just so many factors, and you really do get pay you do pay for what you get for with lawyers. A good lawyer can really set you apart from just being an average company to being a great company strictly by just protecting you. So Marco, thank you so
Yeah.
much for having these conversations with us. Now, if our startups want to reach out to you and go, hey, I love Marco, what he's saying, he gets me. How do you want people to contact you?
You can contact me by email.
Okay.
Uh,
Do you want to give
yeah,
your email?
it's MW. Sure, yeah, I would love to. It's MWAI at McCarthy .ca.
Okay.
And I always respond very quickly to emails. It's
It's true. I
just the
will
nature of
attest
the
to that. That
job.
is that is
Yeah.
factual. Um,
Yeah.
I really appreciate you, Marco. You and I have to bring you back on this episode, on another episode. Maybe we'll pinpoint a case study
Oh,
or
I would
something.
love to.
Yeah. So,
Yeah.
thank you for making the time, and thank you for giving your expertise to our listeners. Really appreciate you.
It's I love being on your podcast, and thank you for giving me my first podcast
Of
experience. It's been
course.
a pleasure.
I think we made a very dull and a conversation that no one wants to have. We made it somewhat fun and educational. So that's the point, right? So, um,
Yeah, I think so. We're pretty fun people,
yeah.
so we do our best.
All right, Marco,
Yeah.
thank you. And everybody at the Founders Corner, thank you guys for tuning in and listening in on this, I would say, very important topic of just making sure all your documents are in order when you are starting going through series, funding rounds, and everything else in between. Until next time, Corridor out.